Hi guys, welcome to my channel. Before we get started, make sure to hit that like button. Also subscribe to my channel. Investing in index funds, exploring the pros and cons. So make sure to watch the full video. Introduction. In today's fast-paced and unpredictable financial markets, investors are constantly searching for ways to maximize their returns while minimizing risks. Index funds have emerged as a popular investment option for those seeking a diversified portfolio at a relatively low cost. In this blog, we will delve into the pros and cons of investing in index funds, enabling readers to make informed decisions about their investment strategies. 1. Understanding index funds. A definition and purpose of index funds. Index funds are mutual funds or exchange-traded funds, ETFs, designed to replicate the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. The purpose of index funds is to provide investors with broad exposure to a specific segment of the market. Key features of index funds. Index funds aim to match the performance of a particular index, rather than actively selecting individual securities. They typically have low turnover, as they only adjust their holdings when the composition of the underlying index changes. This passive approach to investing helps keep costs low. How index funds differ from actively managed funds. Unlike actively managed funds, where fund managers make decisions on which securities to buy and sell, index funds aim to replicate the performance of a specific index. This passive approach eliminates the need for constant portfolio monitoring and reduces transaction costs. 2. The pros of investing in index funds. Low cost advantage. Reduced management fees and expense ratios. Index funds generally have lower management fees compared to actively managed funds, as they require less manpower for research and decision-making. Additionally, their expense ratios are typically lower due to their passive management style. Elimination of high transaction costs. Since index funds aim to match the performance of a specific index, they have lower turnover compared to actively managed funds. This results in reduced transaction costs, as fewer trades are executed within the fund. Diversification and risk reduction. Spreading investments across multiple asset classes and industries. Index funds invest in a broad range of securities within a specific index, providing investors with instant diversification across various asset classes and industries. This diversification helps reduce the impact of any single security's performance on the overall portfolio. Mitigating the impact of individual stock volatility. By investing in a diversified index fund, investors are less exposed to the risk associated with individual stocks. The performance of any single stock within the index has a smaller impact on the overall fund performance. Consistent market performance. Matching market returns. Index funds aim to replicate the performance of a specific index, resulting in returns that closely mirror the overall market. Over the long run, this consistency in performance can be beneficial, especially when compared to actively managed funds that may struggle to consistently beat the market. Outperforming actively managed funds in the long run. Numerous studies have shown that over longer time horizons, the majority of actively managed funds fail to outperform their benchmark indices. Investing in index funds allows investors to capture the market's performance while avoiding the potential pitfalls of active management. Simplicity and accessibility. Passive management requires minimal effort and expertise. Index fund investing is relatively straightforward, making it an attractive option for novice investors or those with time constraints. The passive management style eliminates the need for constant portfolio monitoring and reduces the complexity associated with active stock selection. Suitable for novice investors or those with time constraints. Due to their simplicity, index funds are an accessible investment option for individuals who do not have the expertise or time to actively manage their investments. It allows them to participate in the market's performance without the need for extensive research or constant decision-making. 3. The cons of investing in index funds. 2,000 words. Limited control over portfolio composition. Lack of ability to actively respond to market conditions. Index funds aim to replicate the performance of a specific index and are not designed to actively respond to market conditions. As a result, investors have limited control over the composition of their portfolios, and they may not be able to adjust their holdings to take advantage of potential opportunities or mitigate potential risks. Inability to exclude specific stocks or sectors. Investors in index funds must accept the inclusion of all stocks or sectors within the chosen index. This means they cannot exclude specific stocks they may consider overvalued or sectors they believe are experiencing downturns. Underperformance during market cycles. Inability to outperform during bull markets. Index funds are designed to capture the overall market's performance, which means they are unlikely to outperform during periods of market exuberance. While this may be a disadvantage in bull markets, it is important to remember that index funds tend to be less volatile during market downturns. Reduced flexibility to capitalize on market inefficiencies. Actively managed funds have the flexibility to capitalize on market inefficiencies by buying undervalued stocks or selling overvalued ones. Index funds, on the other hand, lack this flexibility, as they must adhere to the composition of their chosen index. Potential for overweighting overvalued stocks. Exposure to overvalued or declining companies within an index. Index funds replicate the composition of a specific index, which means investors may be exposed to overvalued or declining stocks within that index. This can result in a drag on overall performance if those stocks underperform or experience significant declines. Inability to mitigate overexposure to certain sectors or industries. If an index is heavily weighted towards a specific sector or industry, investors in index funds will be exposed to a higher concentration risk. This lack of control over portfolio composition can limit an investor's ability to manage their exposure to certain sectors or industries. Capitalization-weighted bias. Overweighting larger companies within the index. Most index funds use a capitalization-weighted methodology, where larger companies have a higher weightage in the index. This means that investors in index funds may have an overweight position in larger companies, potentially missing out on the growth potential of smaller companies. Ignoring the potential of smaller companies with higher growth potential. Index funds may overlook the potential of smaller companies that are not included in the chosen index. These smaller companies may offer higher growth potential, but are not captured in the passive investment strategy of index funds. 4 tips for successful index fund investing, 1,000 words. Determine investment goals and risk tolerance. Investors should clearly define their investment goals and assess their risk tolerance before investing in index funds. This will help align their investment strategy with their financial objectives. Evaluate expense ratios and management fees. While index funds are generally low-cost investments, it is essential to compare expense ratios and management fees among different funds. Investors should opt for funds with lower expenses to maximize their returns. Select appropriate indices and fund providers. Choosing the right index and fund provider is crucial for successful index fund investing. Investors should research and select indices that align with their investment objectives. Additionally, they should evaluate the reputation and track record of the fund provider. Regularly monitor and rebalance the portfolio. Although index funds require minimal effort, investors should periodically review and rebalance their portfolios to ensure they remain aligned with their investment goals. This involves adjusting the weightings of different funds to maintain the desired asset allocation. Consider diversification beyond index funds. While index funds offer diversification, investors should also consider diversifying their portfolios with other asset classes, such as bonds, real estate, or international investments. This broader diversification can help further reduce risk and enhance potential returns. Conclusion: index funds offer an attractive investment option for individuals seeking simplicity, low costs, and broad market exposure. However, it is essential to understand the limitations and potential drawbacks associated with this investment strategy. By weighing the pros and cons discussed in this blog, investors can make informed decisions that align with their financial goals and risk tolerance. Successful investing requires continuous monitoring, periodic adjustments, and an understanding of the overall market conditions. So, whether you choose to invest solely in index funds or combine them with other investment vehicles, always prioritize diversification, risk management, and long-term financial planning. By carefully considering the pros and cons of index fund investing and following the tips outlined in this blog, investors can make informed decisions that align with their individual circumstances. Remember, investing is a long-term journey, and regularly reassessing your investment strategy and goals will help you stay on track toward achieving financial success. What do you think of our video? Let me know in the comments section below. If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go.